30 years ago, a retiree walked into his local bank and purchased a certificate of deposit paying nearly 5%. At the time, it felt like the safest financial decision imaginable. His principal was protected, the bank was reputable, the interest payments arrived exactly when promised. He slept well at night knowing his money wasn't exposed to the stock market. Fast forward 3 decades. The stock market experienced crashes, recessions, a financial crisis, a pandemic, and countless headlines predicting disaster. The retiree avoided all of it. Yet when he looked back over those 30 years, something surprising emerged. The greatest threat to his financial plan hadn't been a market crash, it had been inflation. While his money remained safe from volatility, its purchasing power steadily eroded. The world became more expensive. Healthcare costs rose. Housing costs rose. Everyday expenses climbed higher. The risk he thought he avoided simply arrived through another door. And that's the funny thing about risk. Most people spend their lives trying to eliminate it, but risk can't be eliminated. It can only be exchanged. Avoid market risk, and you take on inflation risk. Avoid liquidity risk, and you may sacrifice returns. Avoid short-term volatility, and you may increase long-term uncertainty. Today, we're talking about the many forms of risk hiding inside our financial lives, and why wise stewardship isn't about avoiding risk altogether. It's about understanding which risks are worth taking. Welcome to Plan to Prosper, where we exist to honor God by helping faithful servants steward their finances wisely and build wealth that endures for generations. Alrighty, here we are yet again.
Talking about risk.
Risk.
My favorite thing, unless, as we talked about before, I'm in an airplane.
100%. It's too risky up there.
Yeah.
It's actually one of the safest things you could possibly do, and yet it doesn't feel like it.
Yep. Feels like one of the most deadly things I'm going to do.
I was reading an article once about fear of flying, and the guy was like, if you want to live longer, you should probably fly more. He's like,
spend your whole life in the air.
Yeah. Because now it's a little tongue in cheek because you're actually exposed to some like moderate radiation when you're that high. So like pilots have some extra risk involved in their lives, not because of crashing, but because of like radiation exposure by being higher up in the air. But nevertheless, his point was that flying is so safe that you could do it all the time and you'll never get into an accident. But it takes you to places where it will help ease some stress. You get to go on beautiful vacations, and so you should probably do it more.
But now it sounds like we're flying in a microwave at 35,000 feet.
A little bit.
Ugh, I knew it was bad for me.
Yeah. Also, when you first said risk is one of my favorite things, I thought you were referring to the board game.
Oh, that's
Is it?
Yeah. I love the board game risk.
Do you?
It has
Okay.
been way too long. My kid, my oldest is 8. I think it's time to introduce him to it.
It might be.
Yeah.
I haven't played it since high school, but I feel like that would be a good thing when my son's 3, so it's not going to happen for a while. But
Nice rainy day.
someday, yeah.
Yeah.
Let's go. Yeah, so we're going to be talking about risk. There was a couple episodes ago where this idea came up briefly, and I think it was a conversation I was having with Jake about risk. That like there's nothing risk-free truly in your financial life. There is going to be some risk that you're exposing yourself to, and we just want to open the door on that and talk about. We're not even going to talk about all of them because there's more than just what we're going to talk about today. We're going to talk about a handful of them and why it's not the worst thing in the world.
Yeah. There is a risk-free rate, which people in investments talk about, but a lot of times, if you're only getting the risk-free rate, you're not going to be able to achieve your financial goals.
Yeah, you're exposing yourself to another, like a little bit more on the inflation risk potentially. Yeah. So anyway, so the idea today is not like, I think a lot of people get duped by really clever marketing, and the idea of crash proof or guarantees, all these things that some types of financial advisors are legally allowed to throw at you can sound really enticing. But there's other risks at play that you just are not aware of that aren't going to be front and center on the advertising material. So
because crash proof, I haven't looked into it enough. It might be completely true, but you're also maybe not getting enough return.
Right. So,
or paying a lot of money.
Yeah. The main point today is that risk should not be your enemy. You should not be seeking to eliminate all of your risk in your financial life, because the reality is you can't really do that.
Yeah. Yeah. We had a decent amount of calls, like people saying like, I want something that's going to give me like 7% return, but it's not going to go down at all. Like, well,
good luck.
Yeah.
Yeah.
Let me know when you find it.
Yeah. The problem is there's no such thing as a risk-free financial plan. So we need to figure out the right way to mitigate or spread out, diversify those risks as broadly as possible so that you're covered on as many of these bases as you can be.
Yeah, and some goals may require more risk, and some goals may require less risk. And so that's part of kind of stewarding those funds well, is determining how much risk you can take with the money that you're saving for a variety of goals.
And this doesn't just apply to finances. We've already mentioned the plain thing. Like, you can't live your life without taking on risk. You could choose to just go insular and live inside of your house for the rest of your life, but you're taking on a ton of other risks by doing that. Like, you're afraid to get in a car because you might get in a car accident. You're afraid to get in a plane because it might crash, all these things. So I'm just going to stay in my house and I'm going to be perfectly safe in here. Well, all of a sudden you've just introduced some new risks, like you're not getting exercise and getting out into your social life. You're going to become, I mean, you've seen examples of people that are hoarders and living their lives in this exact way. And it's like, that person looks like the opposite of a healthy, functional human being. They are completely detached from society. The Unabomber was one of these people, like this is not a good way to live your life, by trying to eliminate all this risk from safety as possible, when in fact you're actually introducing some new risks and kind of becoming a crazy person. There
can also be some dumb risk. Like, I'm the kind of person that if we are taping this at 9 o'clock in the morning, I like to think of myself as efficient, and I like to walk in at 8:59 in the morning. Mm-hmm. Sometimes that doesn't always work, and a dumb risk would be like, oh, I'm running a little late. It's a red light. Let me just close my eyes and floor it.
Do you do that?
I've never intentionally done that.
Yeah.
I have unintentionally gone through a light and thought, oh, that was a red light, I think, and there was nobody there. That happened, I think, once or twice in my life.
I like how you said, close my eyes and floor it. Like, there's three things that you're running the red light, you're flooring it, and you're deciding to close your eyes throughout. I think that's a funny concept.
So if you're going to do it, you may as well go all out.
Yeah, agree. So yeah, life requires risk. Getting married and having kids is risky.
Yeah. All of a sudden, it's not just you.
Yeah. You're bringing in other souls into your circle that you're very, very much responsible for. And that's a risky thing, but it is 100% worth doing.
Prior to marriage and kids, I was like, worst case, I'm on the street and I can figure it out. But like, then you have a wife and kids and it's like, well, I don't want them to.
Exactly.
Like, I got to make sure I make this work.
Yeah. When I was single, I lived in kind of a sketchy neighborhood and I didn't care at all.
Yeah.
I had a baseball bat by my front door and that was good enough for me. And then all of a sudden I got married and I was like, "Boo, I got another person to protect. Should probably be better at this. Got a security system and other things to protect my family."
Well, you got married and then just started having kids. You're pretty quick.
Yeah, true. What else is risky in life? Changing jobs, starting a business, all that stuff.
Yeah. Investing in general.
Yeah. Matthew 25 is the parable of the talents. We've talked about this a lot, but that there's an expectation to not the one that avoided all risk technically by burying it in the sand is the one that gets sternly rebuked for being wicked and slothful. So the goal biblically is not avoid all risk. It is appropriately taking the right risks.
Yeah. Be a productive human being.
Did you see that video from a couple weeks ago of that poor girl that it was in like South America and she thought she was bungee jumping.
Yeah.
And they just tossed her.
Dude, that was awful.
And they didn't put a rope on her.
They forgot.
Yeah. So that's
Would you ever do that? Would you ever bungee jump?
No. I skydived once.
Really? You don't like flying, but you skydived.
Yeah, that was...
You're crazy.
That's a whole other story. It was kind of an accident, but it happened. It was fine. It was a lot of fun. I would never do it again, though.
That's nowhere near anywhere on my bucket list.
Yeah. Yeah, anyway, all right, let's get into the actual financial risks. Enough about that. So number one, inflation risk. Let's talk about that.
Yeah, I mean, it's the one that people don't really realize because you can have $1,000 in your bank account and not spend any of it, and the next month you're going to see $1,000 and you think, I'm fine. I have the same amount of money in my bank account. But you don't realize, but a lot of people don't connect what they have in their bank account. I don't know. It's a weird mental thing with what they're spending at like the gas pump or the grocery store.
Right.
So it's easy I mean, you hear people talk about like, oh, inflation, like I'm spending X amount on whatever at the grocery store, but they don't connect that, oh, my $1,000 is now worth 980 or whatever it might be.
So I was curious. I wanted to kind of see some different time horizons and look at the average inflation rate annually across 4 different time periods. So I looked back at the past 30 years from around 1995 to 2025. Inflation ran at about 2.53%.
Like average annual?
Annually. So a cumulative of like 100 something percent. I can't remember what it was, but if we cut that off by 10 years and we do a 20-year period from 05 to 25, it rose a little bit, about 2.55%, but still right around 2.5%. And then when we get closer to recent, if we go from 2015 to 2025, so just a 10-year period, it jumped up to 3.18% on average annually. And then if we fast forward to 2020 to 2025, during those like heavy inflation years early during the COVID years, it rose up to 4.11% annually. It's now starting to go back, but the average over the past 5 years is still pretty high.
I would guess if you looked at 10 to 20, it was like 1%.
Really?
Yeah.
Okay. I did not do that time horizon. But with that, I wanted to give you a quick little quiz. And
oh no, you might have taken my game for you. Let's see.
Oh, is that right? All right. So let's imagine you have $100,000 and you put it under a mattress. You're not even putting it in a bank where you get some level of interest. So let's just assume there's no interest payments on this $100,000. We're just going to talk about the buying power of that $100,000 in those time horizons that I just gave.
Okay.
So let's work our way backwards.
All right, so this one's good.
If you put that $100,000 under your mattress in 2020, fast forward to today, what's your buying power of that $100,000?
So average was like 4.55?
4.11.
4.11.
We'll see how good at math you are.
I'm not that good at math. You said 100,000?
100,000.
91.
81.
Ugh.
Yeah. So it's only been 5 years.
Bad at math.
It takes $20,000 off your 100,000 in buying power. Let's go back to 2015. So we've got that 3.18% inflation rate annually. How much is $100,000 worth today if you had put it under your mattress in 2015?
68.
Close, 73.
Okay.
So it's not, that one was like maybe the most surprising to me, that it's like, that's not that bad. It's still bad, but
still losing almost $30,000.
Yeah. All right, let's go back to 2005. You put it under your mattress in 2005. How much is $100,000 now worth in your buying power?
51.
60.
Okay.
All right, finally, 1995. You put it under your mattress. What is your buying power of your 100,000?
47.
Wow, $47,300.
Nice.
You nailed that one. Cool. Yeah. So that's just a little exercise, and we keep an eye on this in our financial plans. We keep an eye on the future value and the present value of your dollars, so that you can just see, wow, in 10 years I'm going to be a millionaire, but it's really only going to be worth
like
about like $700,000, whatever.
Whatever it is.
So it's just an important thing to keep an eye on. Inflation is a real thing. You have to be aware of that, and keeping everything in cash is not actually avoiding risk. You're introducing this risk fairly significantly.
All right, well, I looked into a couple things for you.
All right, let's go.
We're going to play the prices right.
Ooh.
I'm going to make you guess prices. A pound of beef today is worth $6 on average, $6.75.
Okay.
What was it worth in 2016?
Like, what was the price?
What was the price? Yeah, what was the price?
I'll say $4.99.
$3.75.
Wow. Okay.
Dozen of eggs. On average, this kind of surprised me. On average, it says right now it's $2.20.
That's cheaper than I would have thought.
Yeah. What do you think it was in 2016?
$1.50.
$1.68.
All right.
A gallon of gas right now. I didn't look up actual averages for today. I just looked at the pump on my way in. $3.99.
Yeah.
2016.
I'll say 3.
$2.14.
Really? Why do I not remember that?
I hope that's a 1. I think that's a 1. Electricity per kilowatt hour.
Okay.
All right, 2026, it's on average 19.2 cents right now. What was it in 2016?
10 years ago. I'll say 10 cents.
13.5 cents.
Okay.
Last one, coffee. A pound of coffee today on average is $9.53. What was it in 2016?
$6.
$4.39.
Really?
That one surprised me. That one jumped quite a bit.
Yeah, because all these coffee snobs and all these
Yeah.
roasters are coming out and trying to become more ethical with their coffee roasting and sourcing of beans and all that stuff. So,
I got a really good amaretto coffee recently from Amazon.
Amaretto.
So good.
what is that, hazelnut? Or
No, it's almond. Yeah.
Yeah. Sweet. Man, I love coffee. I want some more right now. I drink too much of it though. So yeah, inflation is real. Was that the last of it?
Yeah, that was the last of it. You were sick of it. You were done.
Yeah, I'm done. Done with your games. Yeah, I think we talk about having cash is an important thing, having your emergency fund in cash, and we'll talk about another risk later that kind of ties into this, but it's important to have
having your emergency fund in something like cash is good.
Yeah, sorry. When I say cash, I'm referring to high yield
Like
savings
just like
accounts.
under your mattress.
Yeah.
Having your emergency fund in cash is bad. Like
Right.
dollar like bills.
Right.
I'm
when I use the word cash, I'm encompassing things like
yeah.
high yield savings accounts, and I'm saying we recommend having your cash, but I am referring to a high yield savings account. Because you can you can have it in cash, quote unquote, in this high yield savings account and be earning 3% to at least keep pace with inflation.
Yep.
At least for now. So we're not totally anti holding cash, but there is liquidity risk. Or I'm sorry, we're going to talk about liquidity risk later. There is inflation risk at play.
The high yield's supposed to basically keep up with inflation,
Yeah.
but it might not always. Like they never hit 9% back in 22 or whatever.
Right.
When inflation hit 9%.
Okay, so that's inflation risk. What's the next one?
The risk in the markets. So you invest $100,000, it can go up or it can go down.
Yeah. Think of it like a massive storm in a harbor, and you've got all these different boats. If a massive hurricane hits, no matter how big and sturdy your boat is, it might get pushed around a little bit.
Yeah.
It might be a little bit safer than a rowboat, but it's still going to be pushed
Hopefully.
around. So your risk in the market, you could have riskier investments and less risky investments. But when there's a massive, let's use the financial crisis of 2008 or even 2022, everything gets affected by it.
Yeah. Yep. Yeah. With those massive crises, most investments start correlating in those times. Occasionally, you can find something that doesn't. You could in 2008 and you could in 22, but it's few and far between.
Yeah. So the market risk kind of applies to the whole ecosystem of investing.
Yeah.
And it can't totally be eliminated through just total diversification.
Right.
Obviously, that's the goal. And in just normal years, that there will be non-correlating assets where, as you're saying, like can help sturdy the boat when other parts of it are going down. But in huge market downturns, probably everything's going to get affected.
Right.
Because you're suddenly introducing investors who are just kind of panicking and selling everything, whatever they can.
Yeah.
So it's going to kind of affect that.
To go to cash. Yeah.
There's also, go ahead.
I was just saying on the flip side, you also have when you're introducing market risk, you're participating in those market storms, but you're also participating in bull markets and speculative markets and just positive volatility in general as well.
Right. Yeah. So we're just talking about the downside of it, like what this risk exposes. But there's a reason you take this on.
Right.
Because the upside is so important. And I think another key aspect of this is that the volatility and these downturns is not, you're not realizing these losses unless you panic sell. So if the index drops 20%, you just hold it, you have on paper losses, but unless you actually sell everything, you're not permanently destroying your capital, right? Like just keep it in there, because at least to this point in history, when those markets have gone down, they've come back.
Yeah. Now, if you have a good advisor, they'll do some tax loss harvesting and realize those losses, but then get you right back in.
Yeah. So this risk also kind of ties into one that we'll touch later, the behavioral aspect of it and the psychological toll that market downturns have on investors. That's a real thing, and you need to be aware of that so that you don't panic in the downturns and just get out and actually make your financial plan significantly worse, even if it feels like you're making the right move.
Yeah, I wrote some numbers down for that, but I'll wait until we get to the behavioral risk before I go over those numbers.
You can't outrun market risk, but you can manage it. And so there's this risk is going to be tied to the behavioral risk that we'll get to later. And I think it's an important thing to be invested in the markets and to know what you're getting into so that your stomach doesn't drop when the markets do.
Yeah, and really the only way to beat inflation is to introduce this kind of risk.
Right. Yeah, exactly.
To some degree.
Yeah.
You don't have to be full throttle market, 3x leverage.
Exactly. Because we believe in the appropriate risk tolerance asset allocation as well, that you are not overly aggressive when you don't need to be or you shouldn't be. That you're in your retirement years or approaching retirement and you toggle up your aggressiveness to 100% and you just go all in on equities or whatever. Like we want to be in the appropriate risk tolerant, the asset allocation for where you're at.
Yeah.
Great. What's the next one?
The next one is liquidity risk. And a lot of people actually don't understand the word. But it's basically just whether or not you can easily turn your investment into cash.
Yeah. When we did our episode on I can't remember what we talked about, what the episode was called or anything. So forgive me, but we did like a hierarchy on friction hierarchy for trying to reduce or increase friction on the things you buy, so that you don't impulse buy things that you don't need to. And so I came up with a little bit of a liquidity hierarchy here too, along the same lines, because not everything has the same liquidity, obviously, and so cash is the most liquid. Cash checking savings. Again, I'm using that word all inclusively. That it's the highest liquidity. You can access that money pretty much right away. Right. Maybe a high yield savings account, you got to transfer it to your checking account.
It might take 24 hours.
Yeah. But in general, it's very liquid. Then you kind of drop that down to a taxable investment account where, again, you can have access to that pretty quickly within a couple of days.
As long as you're not investing in weird stuff. Yeah.
Right. Yeah. So just normal mutual funds, stocks, not private equity or anything like that.
Nothing unique in that sense. Not weird. But unique is probably the better word.
Yep. You'll be introducing things like capital gains if you're realizing gains in that situation. So you have something to be mindful of there. But it's liquid for the most. For all intents and purposes, it's fairly liquid. I would say then the next one would be maybe Roth IRA contributions. It's technically liquid, but it is not advisable. So you do not want to be doing this, but you can theoretically pull that without a penalty. But you're really sacrificing. There's an opportunity cost here where you're taking out tax-free growth on these dollars that you're removing forever.
Yeah. And you can even potentially do it without a penalty on everything if you fit into one of the loopholes.
Sure. But yeah, in just kind of all other circumstances, you could pull out the contributions without paying a penalty.
Yeah.
Before 59.5. Obviously, if you're past 59.5, you can pull it out. But
so potentially the other one that might fit in there, probably similar, is a whole life policy.
Okay.
If you've gotten into a
cash balance.
Yeah.
From there would be traditional IRA, 401k, not really that liquid. You could do it if you're before 59.5, but you're going to pay ordinary income tax on it and a 10% penalty. So don't do that.
Yeah.
That's not a good idea. And then finally would be real estate or the private equity stuff that you're saying. There's very little to no liquidity here. It would there will be a lot of time to sell something to it's just not going to happen quickly. You can get it, but it'll take some time.
Unless I would say the only caveat is if you have a HELOC that's already open for you.
So, but again, you're then introducing some interest that's working against you in that sense, right? So
you're introducing additional risk. Yeah.
So liquidity is not just about how fast you can get it. It's also about the fees, taxes, other things associated. So the high yield savings account is probably it's going to be the best in terms of not having fees and stuff associated with getting that money into your account quickly.
Yeah. Did you ever watch Modern Family?
No.
There was one episode, I can't even remember what it was about, but Luke, the little kid, said something about hearing his dad talk about freezing his assets. So he's like, I did the same thing, and he pulls out a big block of ice, and he's got dollar bills in the ice. That's not what that means, but
yes,
good attempt.
Yep. So yeah, some illiquid real estate, private investments, business ownership, annuities. Obviously an annuity is put in place to give you income when you start annuitizing it. But if you need more than what you're allowed to take out, annuities
surrender.
They don't want you to do that, and so there's going to be some surrender charges with that. CD ladders. I wanted to bring this one up because I have this like goal of putting my emergency fund. I kind of like CD ladders, and you're probably not going to like this, but I want to run this by you. What I think I want to do with my own emergency fund. I'm not giving this as advice to anybody else, but it's just what I want to do. I want to have 3 months. So we talk about 3 to 6 months of living expenses in your emergency fund. I want 3 months to be in a high yield savings account where that's just always available. Then I want the other 3 months to be on this CD ladder where it's kind of this rotating. There's like 4 tranches every year that mature every 3 months. And then I just keep buying another 12-month CD for the following.
I kind of like it, but I think instead of CDs, you should do T-bill ladders.
Oh, is that right? Okay.
Because CDs, you're going to get hit with fees if you need it early. T-bills, they're pretty liquid, so you're probably not going to sell for much of a discount.
All right. But again, the point of I still have the 3-month buffer and then every 3 months another tranche comes. So hopefully I wouldn't need to withdraw at all.
Right.
Save for just a crazy emergency or anything. But that's my idea.
But I think typically you can also get more in T-bills than CDs.
Really?
Yeah.
Oh,
because the CDs are usually just using T-bills. So then they're taking a little bit and giving you the rest. But
all right.
That's how they're making their money.
Good. So we see this sometimes with clients that have a really high net worth, but it's all in a 401k and all in their real estate, and they have nothing else.
I have a house and 2 vacation homes and $50,000.
Yeah. So you have a great net worth, but you are cash poor, and it's kind of tough. Mm-hmm. But still, you could over time figure out a way to increase your cash position, obviously. But yeah, liquidity risk is a real thing.
Yeah, definitely.
All right, what's the next one?
Oh, one more thing on liquidity risk,
though.
The one thing you want to make sure that you're doing if you are introducing liquidity risk, like in some of those private investments, you want to make sure that you're getting paid what they call an illiquidity premium. So if you're intentionally getting into things that don't provide you with liquidity, you want to make sure that you're actually getting paid an adequate amount for that.
Yeah, that makes sense. Okay, next one.
Concentration risk. And I feel like I'm still trying to figure out why. I think part of it was COVID and people being bored, but I think we see concentration risk more and more these days of people like finding the one stock that they like or the one investment that they like, and almost like what was his name, James Holzhauer, whenever he would do the daily double in Jeopardy, he would all in. That's what people are doing with their investments now, all in on that one.
Yeah. There's a classic saying, don't put all your eggs in one basket. And there's a reason for that, because you can get really wealthy with introducing a lot of concentration risk. If you invested in the right stock and it just goes gangbusters, that's pretty great.
Yeah.
But you could lose it all pretty quickly too.
Yeah.
So you got to be careful here. I think if you're an employee at a company that offers stock options as part of your compensation, RSUs, things like that, you're going to be accumulating a decent amount of your own company's stock. Mm-hmm. You might want to come up with a plan to slowly over time diversify that so that you're not building your net worth on that stock. Because
sometimes it can absolutely be worth it. Like some companies will say you can buy $25,000 a year of our company stock at 80% of.
Right.
So you're creating free money for yourself in that case. But yeah, as you said, you also want to make sure that you're not introducing that much concentration risk that you've done it, you reach 55 or whatever, almost all of your investments are in company stock and it plummets, now you can't retire.
Yeah, you saw that with Enron when we discussed the financial crimes. A lot of employees had Enron stock in their 401ks that they allowed them to do that. And then when Enron was going under, the executives like switched 401k providers or whatever it was and froze the employees from being able to do anything in their 401ks. So they were just stuck with this Enron stock. And then in that 30-day period or whatever, before they could start selling stuff, Enron completely tanked. So it was like real shady. And a lot of these employees lost a lot of their net worth because they were all in on Enron.
Right.
So I would say like it is even okay to not necessarily have a plan to diversify that as long as you're building your other assets elsewhere. I think it's okay if this is a piece of your financial plan, 100%, that's fine. But I think you have to be willing to lose it all, and or at least a decent amount of it, and your financial plan still works because you're also building a good 401k that's plenty diversified. You're building a taxable account elsewhere that's like you can be building that alongside of some other things. And if you're willing to, like, if you're so bullish on it, but your plan works, even if that went to nothing, we'll run those like worst case scenario for people that have this situation, and just go, yeah, you don't actually need this for your financial plan to be successful. It gets a little dicey. So if you really don't want to diversify that and you want that to be a part of it, well, I think you should build in some contingencies.
The other one that people get very concentrated in is Bitcoin. I mean, I think it was at some point last year, I can't remember when, it was like 125,000 per Bitcoin. People that were super concentrated in it are now seeing prices at under 60,000 per Bitcoin. So, anything can have concentration risk.
Do you have a conviction on, with any one stock, that it shouldn't be more than X% of your portfolio?
Yeah, I personally try to stick with somewhere between 5 and 10.
Okay.
Typically, especially like if I've let something go on a run and I'm getting a little bit nervous about it, I'll get it back down to 5.
Okay.
And I would say, 10 is like absolute max.
Let's say somebody is putting all their money into an S&P 500 index, and they're just putting everything into that, and they go, I'm owning 500 companies here. Are they diversified enough?
Not enough. They're diversified in that if one of the 500 companies go down, they're not going to. I mean, if Microsoft went down, then they're going to feel it.
And why is that?
Because the S&P is market cap weighted, so Microsoft is a much higher percentage of the S&P than. I don't know. I can't even think of one of the smaller companies, but the number 495 in the S&P. But I mean, we would say the S&P exposure to S&P type risk belongs in a portfolio, but I think right now our max exposure in any single portfolio to the S&P 500 type is probably. From a passive core standpoint, it's like 25%.
Okay.
But then when you introduce like actively managed funds, it's probably pushing 40%.
Okay. Yeah. So if you just were to picture a pie chart of the S&P 500, it's not 500 equal little slices.
Right.
The big companies are going to take up huge pieces of the pie.
I think the top 10 right now are like 40% of the S&P.
Yeah, that makes sense. So that's just something to be mindful of. Sounds like you're diversified because you got 500 companies, but you're really heavily weighted towards the big ones.
Yeah.
Great. Any other thoughts on concentration risk?
No, I think we're good.
Okay. What's the next one?
Interest rate risk. So we got into this a bit with bonds when we talked about bonds a few, 5-6 episodes ago.
Yeah. So go listen to that episode.
Yeah.
Because we touched on all this, but we'll briefly recap it.
But yeah, I mean, people think bonds safe. Bonds are, depending on the bond, relatively, compared to equities, relatively safe over the maturity period. Mm-hmm. So like if you hold it from issue to maturity, you know what you're going to get. The caveat to that is if you're buying a junk bond, the company could go under and default on the bond in that time period. So really, you got to look into the bond. You got to look into the time horizon. Are you going to hold it to the end? You got to look into if you're not going to hold it until the end, what are interest rates going to do to the bond while you're holding it? And then you also have to look into the issuer of the bond and determine the credit quality and whether or not you think that you're actually going to get your principal back. Is the company still going to be there? Or is the U.S. government still going to be there in 30 years? I mean, the U.S. government's looked at as the risk-free rate still right now. But yeah, if you're getting into even a bond from Microsoft, will Microsoft still be here in 30? Will they still be able to pay it? It's not a no-brainer. There's definitely some risk.
Yep. So just changes in the prevailing interest rates are going to affect your investment value.
Yeah.
If the interest rates go up, the bond prices go down. If interest rates go down, bond prices go up.
Yep.
It's easy as that. So go listen to our episode on bonds. We do a whole deep dive on that. Next one is longevity risk. This is the risk of running out of money.
Yep. People, it's funny. Social Security still, I think, relatively similar age from when it started. But people keep getting older and older. So we have to keep building plans that assume that you need Social Security plus to make it to, age, those higher ages.
Yeah.
The risk is that you're going to outlive your portfolio, that you're going to reach age, retire at 65 or whatever, reach age 85, and all of a sudden you're out of money.
Yeah. Yeah. If you look at like average life expectancies, it's something like 77 years old or something. But like
I actually have this.
What's that?
For the male, it's 76 and a half years old right now.
Okay. But that includes infant mortality, like early life accidents and things like that. It's just like kind of the all-in average for all deaths.
Yeah.
And when you make it to 65 years old, your chances of living to age 85 or 90 are pretty high.
Yeah, so average age of the U.S. male is 76 and a half right now. The average age of the U.S. male that reaches 65 is 83 and a half.
Okay. Yeah. So you need to be prepared. I think we build all of our financial plans to age 95 right now.
Yeah.
Or if you're in your 90s already, at least 10 years out.
Or we've talked to some clients who say, oh, my parents are still alive and my mom's 99 and my dad's 101 or something. And we'll be like, all right, we should probably run a plan through like 105.
Yeah. One way to mitigate this risk is delaying taking Social Security, as you mentioned, to the latest, which is age 70, because that increases how much you get in Social Security. And the break-even point happens around age 80 or so. Whereas if you take Social Security early, you're reducing your monthly benefit. And if you don't live to age 70, well, that was the right move because you had income the final years of your life. But if you live past 80, past 85, delaying to 70, you get the most out of your Social Security that way because you get the most monthly benefit and it can help support you.
It can also depend on what you have saved though. Because you can also, there are also analyses that can be run where if you have enough portfolio that you don't need like your Social Security really at all, you could potentially take it earlier, assume that you save it, invest it. And so, yeah, there are different analyses that can be run to. So it all depends on your situation.
We often also we can run a longevity risk in our plans where we can actually see the success of the plan by year. So it's like your plan is 100% successful through age 90, and then it starts to dip a little bit.
Yeah.
So
some of them are surprising. Like you're good through 90, but then like 92, you're at like 50%.
Yeah, it goes quickly.
Yeah.
Because it kind of compounds on itself the other way too. So, we like to keep an eye on this, but the other side of this risk would be such anxiety over, and this is why having a good planner in your court is really, really helpful, that you underspend and you live your entire retirement in fear and anxiety and you don't enjoy it at all because you're afraid of running out of money. And so proper planning shouldn't just protect you from the poverty of running out of money. It should actually give you the psychological permission to actually enjoy your wealth and enjoy your retirement and have a planner that says, hey, you can spend up this much in retirement. It's okay. You don't have to cut corners every single chance you get just so that you don't run out of money. We've run the analysis. A good planner will be able to help give you that peace of mind that I'm not going to overspend.
Yeah. It's rewarding to talk to people who, some people, I haven't retired because I don't know if I can.
Yeah.
And like running the numbers and, you could have retired 5 years ago. Like, You're fine.
Yep. All right. I think this is the last one. Behavioral risk.
Yeah.
We'll talk about risk tolerance afterwards, but briefly. But the last risk is behavioral risk. And we talked about it briefly, but this is the only risk that's really inside of your control. All these ones are kind of outside of you. You can help mitigate them.
Concentration is
that's true.
Kind of in your control.
But still the risk associated with it is you can't control whether your company goes to zero or not. Yeah. This one is entirely within your control. It's just, what do you do when the markets drop?
Yeah. And so, we'll get to risk tolerance, but that's where we have seen, and we try as much as we can to talk people out of it, but we have seen people that kind of panic at the worst time.
Yep. Which is, again, it's a natural thing. We've talked about it in other episodes before, but you could have a perfect plan that mitigates all these risks perfectly, navigates all these different risks, and you panic sell when the market drops 20% and you throw all that out the window. And you've ruined your plan because of this one risk, the behavioral risk.
Right. Ruined your plan, ruined just potential goals, college savings, anything like that, just because you couldn't stomach what you might have thought you could.
Yep. Yeah. I think greed, like on the flip side of it, not just panic selling, but like maybe the concentration, over leveraging yourself on the concentration side of things, and putting all your eggs in one basket. I think that's a behavioral thing too, where you're overconfident in this one stock. So you go all in and you're so bullish on Bitcoin that like everything's in Bitcoin. So it's behavioral risk showing up as concentration risk. And when that doesn't work out, your plan again falters.
Yeah.
So this is just another advantage to having an advisor who can help you with the behavioral side of things and help keep you accountable, help give you confidence in not overconfidence, but confidence that, hey, stay the course. We run these numbers for a reason the way that we do because we don't want you to panic when things start to go south. And
yeah, I think it is good accountability, and like it introduces that one more step of like, instead of being able to log on your account and just hit sell real fast, you actually have to call your advisor and be like, hey, can you actually get me out?
Yeah, exactly.
Yeah. It makes you at least think about it more.
Yeah. All right. As we wrap up, we'll
real quick on that.
Go ahead.
Yeah. So I just want to go over 3 stats.
Okay.
So I looked at 3 time periods. If you sell at the bottom, and get in at the new peak. So if you did this in the great financial crisis, so you sold in 2009, got in, I don't think it peaked again until 2013, you would have missed out on 130% returns. COVID, you would have missed out on 50% returns. And in 2022, you would have missed out on 34% returns. So you're missing out, you're missing out on making up those losses, potentially plus some, depending on when you got out. If you panic sell.
We did an episode called When Good Days Follow Bad Days, where we talk about this very thing with real examples of from the Great Depression to the financial crisis to 2022, when there was huge single day market downturns, how quickly there was rebounding days. And you often don't think about that with the financial crisis. It just feels like everything was down all the time, but there was good days mixed in there. And had you panic sold, you would be missing out on those returns and significantly reducing your overall return. So go listen to that one when it comes to the behavioral side of things, because it's a really important aspect to stay the course and don't panic.
Yeah. Yep.
As easy as it is to do that. All right. One final thing that's an important part of what we do as financial advisors is determining a client's risk tolerance and then getting them into the appropriate portfolio to make sure that it's aligned with their goals and what they can realistically handle from a risk tolerance perspective.
Yes. Well, yeah. So there's tolerance and there's appetite.
Yeah.
And so on the appetite side, we use a questionnaire. On the tolerance side, we kind of look at all the different factors. Not just what they think or want risk-wise, but what they have and what their goals are and all that, and what they can handle risk-wise. Yeah.
The questionnaire asks a lot of questions to try to really probe and get to the heart of what you can realistically stomach as an investor. It wants to know, we want to know your goals. We want to know what you're trying to save for. We want to know how much you have to invest. We want to know your age and retirement target so that we have a time horizon in play. We want to know, how do you feel about the markets? Do you feel generally positive or do you feel negative about them? How confident are you in your financial future? Are you pretty anxious about it or do you feel pretty good about it? And then there's like these sliders that are pretty cool. It's like, I'm comfortable risking this amount of money for the chance of gaining this amount of money. And then we just kind of keep increasing those amounts to see what is the amount that you're willing to risk for the potential returns. And that kind of helps get us to a point where we can kind of target a decent portfolio allocation for what it seems like you can handle.
Yeah, and I think it works pretty well because some of them kind of ask, I've seen a variety of questionnaires. Some of them ask like vague questions about how much you can handle. This one actually puts dollar amounts on it. So you can like sit there and imagine, oh, if 50,000 went to 35,000, what would I do?
Yeah.
And so you can actually think like you're actually seeing the dollar amounts. And I think it's probably the closest that you can get without experiencing it. Because I think the only way you can actually tell what you would do is if you experienced it. I mean, I was, during COVID, I saw my personal portfolio lose like 37% or whatever.
Yeah.
And I kept buying. So I know, based on my experience, I know that I can tolerate a lot of risk.
Yeah.
But I think it's a good way to get as close to that type of experience as you can without actually living it.
I think these past 2 years have been pretty good examples too, because we've had, and they just happen to be in the spring of this year and the spring of last year, where something
Like
happened.
beginning of April, basically.
Yeah. And the markets went down pretty significantly in single days. And it's like, whoa, that's a little dicey.
Yeah.
And in both years, they've rebounded pretty significantly. And last year ended up being a really good year in the markets. This year, so far, pretty good too, in spite of those downturns. And so there's like little mini micro opportunity to see what did you do in April when you saw that? Did that make you nervous? It probably made you maybe a little bit nervous, but hopefully you didn't sell or panic in those moments, and you were able to just weather the storm because it came back fairly quickly.
And it also goes back to the plan and what you need the money for and everything, because I personally know that the money that I'm putting in the markets, I don't need for years and years and years. So in both Aprils, I was taking any extra money I had and throwing it into the markets. That's not right for everybody.
Yeah.
So there's the appetite, what you want to do, but there's also, what do I need this money for? Like, if I'm wrong and we're not at the bottom, but we've lost some, and do I have time to get it back, or am I going to need this sooner than that?
Yep. Our whole point today is that everything is risky, and that's all right, because we can help diversify. We can try our best to mitigate the risks, but at the end of the day, you have to be willing to accept the fact that there is some risk in pretty much all of your financial decisions, and the right approach is to know what you're getting into ahead of time, just having your eyes open to it, so that you don't go all in on investments and then the market drops a little bit and you realize this is not what I signed up for. Yeah. It actually is what you signed up for. And you just need to be aware of that so that you don't introduce the behavioral risk and do the wrong thing and actually really damage your financial plan by panicking.
And evaluating all of those risks is part of being a good steward of your finances.
That's right. Yeah. And I think, again, these principles we extend beyond finances. Your whole life. Don't live your life to avoid every single possible risk. That's not a way to live.
Right.
You need to be okay that, you can't eat every single possible healthy food that's perfectly good for you. Every once in a while, like, you can eat a cheeseburger and you're gonna live.
Yeah.
You will.
I can sneak candy out of my kid's candy jar and be fine.
So it's no way to live your life in just constant fear and anxiety of any and all potential risks. Can't live that way.
But also don't accidentally jump out of a plane like Dalton.
Right. Don't do that. Although it was a lot of fun. No regrets. Any other thoughts before we wrap up today?
I don't think so.
Yeah.
Hope everybody had a good 4th.
Yes.
250.
250. We made it.
Yeah. Assuming in a week we're still here and this podcast comes out.
True. Yeah, we are recording this the day before. Yeah. But here's to another 250 years.
Oh, yeah.
Let us all live to see it.
I don't know about that.
Yeah.
Unless Elon Musk's Neuralink and all that stuff.
Yeah. Well, we'll at least be we'll be in eternity.
Yeah.
Alrighty. Thanks for listening. Tune in again next week, and God bless.
God bless.
Investment advisory services offered through Stonecrop Wealth Advisors, LLC, a registered investment advisor with the U.S. Securities and Exchange Commission. This material is intended for informational purposes only.